Silver dropped from $83 to $75 in less than 2 trading sessions. An 11% move that happened so fast, most people are still trying to figure out what triggered it. The financial press is calling it a correction. Some outlets claim the bubble finally burst. Others say speculators got what they deserved after riding leverage too aggressively into year-end. None of these explanations hold up. The fundamentals did not change between Friday and Monday. Industrial buyers did not stop needing silver for solar panels and electric vehicles. Mine supply did not surge. China did not cancel its export restrictions, taking effect in days. Nothing material changed in actual supply and demand dynamics that drove silver from $22 at the start of 2025 to over $80 just last week. What changed was a single administrative decision. The Chicago Mercantile Exchange raised initial margin requirements on silver futures contracts. That change triggered a cascade of forced exits. Traders running tight positions got margin calls Monday morning. Brokers liquidated those positions without warning, without negotiation, without waiting for traders to wire additional funds. The selling hit a market already thinned by holiday closures when the fewest institutional buyers were at their desks. This was mechanical. This was structural. This was exactly what happens when you tighten collateral rules during the lowest liquidity period of the year. The violence of the move, the cliff-like drop on charts, the panic on social media, all stems from timing and leverage dynamics, not from any fundamental deterioration in the silver market itself. The question is not why silver fell. That part is straightforward once you understand futures mechanics. The real question is whether anything meaningful changed underneath the price action. Did the thesis break? Did the supply shortage resolve? Did industrial demand evaporate? Or was this just a technical event, a rules change that forced position closures during the worst possible timing? When you control a silver futures contract, you are not buying 5,000 ounces of physical metal. You are posting a performance bond that proves to the exchange you can handle volatility without defaulting. That deposit is called margin. To control $400,000 worth of silver, the exchange might require you to post $30,000 to $40,000, depending on current requirements. The rest is leverage. This structure creates asymmetric returns. If silver rises 5%, you don't make 5% on your $30,000 deposit. You make closer to 60% or 70% because you control the full $400,000 position. Your returns get amplified by the leverage ratio, but downside gets amplified too. When volatility increases, the exchange can change margin requirements without advance notice. They can raise it Sunday night between trading sessions. They can implement new requirements that take effect immediately when markets reopen. Sunday night, that's exactly what happened. The CME published new margin levels for silver futures. The numbers jumped significantly. Traders who went into the weekend with compliant accounts woke up Monday morning undercapitalized. Positions perfectly legal on Friday were now in violation of exchange rules. When that happens, brokers send margin calls. These are demands with immediate consequences. Add more capital right now or we liquidate your position. Most retail accounts cannot wire cash instantly, especially not on a Monday morning during holiday week when many banks operate with skeleton crews. Wire transfers take time. Approvals take time. So brokers hit the sell button, automatically, without emotional attachment, without concern for whether you think silver is going higher. The broker's computer sees an account in violation and executes forced liquidation at whatever price the market will accept. Now scale that scenario across thousands of positions. Thousands of retail traders and smaller institutions running their accounts near maximum leverage, all getting margin calls at the exact same moment Monday morning, all forced to sell simultaneously, all competing for the same limited pool of buyers in a market already thin due to holiday closures. That is not price discovery. That is a liquidation event, a mechanical unwind driven by rule changes and leverage, not by changes in supply and demand fundamentals. The severity comes down almost entirely to timing. This margin hike hit during the last week of December, what professional traders call ghost week or the dead zone. Senior trading desks are minimally staffed. Risk managers are on vacation. Portfolio managers are with their families. The institutional buyers who normally provide depth and liquidity to commodity markets are not at their terminals. What remains are junior staff running automated protocols, skeleton crews executing pre-programmed strategies, algorithms following rules without understanding context, and thin order books with wide bid-ask spreads because market makers have pulled back their capital. In a normal week during February or March, when markets are fully staffed and liquid, forced selling of this magnitude gets absorbed relatively smoothly. Institutional buyers see the dip and step in. The price might tick down a few percentage points, but then stabilizes because there is depth in the order book. But during Ghost Week, there is no absorption capacity. The selling falls into a vacuum. There are no deep-pocketed institutions standing ready to provide support. The algorithms see heavy selling volume and interpret it as a trend change. So instead of buying the dip, they join the selling. Stop losses get triggered, which creates more market sell orders, which pushes price lower, which triggers more stops in a self-reinforcing downward spiral. This pattern is not unique to silver. It repeats across all leveraged markets when margin changes hit during low participation periods. The combination of forced selling and thin liquidity creates violence that vastly exceeds what the fundamental situation would justify. Now look at what is actually happening in the underlying silver market. Silver is behaving like an industrial commodity right now, not a monetary metal. And industrial commodities operate under completely different rules. This year alone, over 15,000 tons of silver have stood for delivery on COMEX. That is not small. That is not normal speculative activity. Standing for delivery means someone bought a futures contract and demanded physical settlement. They said, "Give me the actual metal. I am taking bars out of your warehouse." Who stands for delivery? Not hedge funds, not momentum traders, not retail speculators. The entities standing for delivery are end users. Companies that manufacture solar panels and need silver for conductivity. Electric vehicle producers who need silver for battery contacts. Electronics manufacturers who need silver for circuit boards. These are industrial entities securing supply for production lines. When industrial buyers stand for delivery, they are not playing games. They are solving a supply chain problem. They cannot source enough silver through normal wholesale channels at acceptable prices or delivery timelines, so they go directly to the futures exchange and pull metal from COMEX warehouses. Once industrial buyers take delivery, that metal exits the financial system permanently. It goes into manufacturing. It gets turned into solar panels that go on rooftops. It becomes components in vehicles sold to consumers. It does not come back to COMEX. This creates a one-way flow. Inventory drains without replenishment. COMEX open interest in silver is down while price is up. This is extremely unusual. Normally, these metrics move together. When prices rally dramatically, speculative interest increases. Traders pile in, hedge funds build positions. Open interest climbs alongside price. That is not happening in silver. Open interest is actually declining. Managed money, the category that includes hedge funds and large speculative traders, is barely participating in this rally. Their net long positions are moderate at best. This tells you something critical. This rally is not being fueled by financial speculation. It is being driven by physical demand that cannot be satisfied through normal supply channels. It is being driven by industrial users who need actual metal and are willing to pay rising prices to secure it. Lease rates represent the cost of borrowing silver for short periods. Under normal conditions, lease rates stay very low, maybe 1 or 2% annually. But in early October, something extraordinary happened. London silver lease rates spiked above 30%. Not 3%, not 10%, 30% annualized rates for borrowing silver. That is acute stress. That is a market screaming that physical supply is constrained. Why do lease rates spike? Because entities that hold physical silver refuse to lend it at standard terms. They look at market dynamics and conclude that if they lend their silver out, they might not get it back, or they might have to pay a much higher price to replace it. So they demand enormous premiums. Right now, weeks after that October spike, London lease rates are still holding between 7 and 8%. That is still elevated. The extreme spike has passed, but the market has not normalized. The tension remains. Lease rates reflect what is happening in the actual physical market, independent of what futures prices are doing. Futures can be manipulated by large traders. Algorithms can push paper prices around, but lease rates are set by entities that hold real metal, making real decisions about whether to lend it. If silver were truly abundant, lenders would compete by offering lower rates. Instead, they are demanding significant premiums because metal is genuinely difficult to source. The available silver in London outside of ETF holdings is estimated at roughly 140 million ounces. The actual liquid supply available for immediate purchase or borrowing is far smaller than the headline number suggests. When large industrial buyers come to London seeking supply, when they cannot get enough metal from refiners through normal channels, they show up chasing that limited pool. And when multiple buyers chase limited supply, lease rates rise. This is basic supply and demand. That is why lease rates have stayed elevated. That is why the physical market can remain extremely tight even when paper futures prices fall sharply during a margin-driven liquidation event. The paper price and the physical market are increasingly disconnected, telling two different stories about the same metal. Now add the factor that has fundamentally broken the normal mechanism keeping global silver prices aligned. China is implementing export licensing for silver that takes effect January 1st. We are talking about less than 1 week away. China is the second largest silver producer. More importantly, China imports doré, partially refined metal that comes straight out of mines before final processing. China imports doré from all over the world because over half of all silver from mining operations globally is actually a byproduct extracted alongside other metals during refining. China has built the refining infrastructure to process all of this doré. They take these rough bars, run them through sophisticated refining processes, extract the silver, purify it to 0.999 fine, and have been doing this quietly for years, building stockpiles, accumulating strategic reserves. The export licensing system taking effect next week is not an outright ban. It is a control mechanism. Companies that want to export silver from China will need to apply for licenses. The application process will require documentation. Processing will take time. Approvals will be uncertain. The bureaucracy will be intentionally opaque. The message is crystal clear. Silver can enter China easily, but getting silver back out, exporting it to serve demand elsewhere in the world, will become difficult. Not impossible, but difficult enough that it changes market dynamics. This breaks the arbitrage mechanism that normally keeps global commodity prices aligned. In a normal functioning market, price differentials between regions close rapidly through arbitrage trading. If silver is trading at $75 in New York and $88 in Shanghai, arbitrage traders should immediately buy every available ounce in New York, fly it to Shanghai, and sell it for $88. When arbitrage traders execute that strategy at scale, the price differential disappears. New York price rises from buying pressure. Shanghai price falls from selling pressure. They converge. That is how efficient global commodity markets are supposed to function. But that is not happening with silver. The spread between Shanghai and COMEX is not narrowing. It is widening. It went from around $10 last week to $13 today. This should not be possible in an efficient market. Why is arbitrage not closing the gap? Because Western financial institutions are calculating the risks and concluding the spread does not compensate for what could go wrong. They look at geopolitical tensions between the US and China. They look at capital controls. They look at the new export licensing regime, and they run scenarios. What if we ship metal to Shanghai, sell it, receive payment in yuan, and then cannot convert those yuan back to dollars at a reasonable exchange rate? What if the yuan depreciates significantly while our capital is stuck? What if we need to retrieve physical silver but cannot get an export license? These are legitimate risk management concerns. The calculus is changing. The spread would need to be much wider, maybe $20 or $25, before it compensates for the elevated risks of having capital or physical metal potentially trapped inside Chinese markets during increasing geopolitical tension. So arbitrage desks are paralyzed. They are not executing the trades that would normally close these pricing gaps. And because arbitrage is not functioning properly, two separate markets are forming. A paper market in the West, centered on COMEX and LBMA, where futures and derivatives trade heavily and prices are set by speculative flows, and a physical market in the East, centered on Shanghai and the Asian supply chain, where prices are set by industrial manufacturers who actually need metal for production and are willing to pay significant premiums to secure it. The paper market has become increasingly disconnected from physical reality. It is an ecosystem of claims, of contracts that promise future delivery, of positions that get opened and closed without any physical metal actually changing hands. Speculators trade these contracts. Algorithms execute strategies based on technical indicators. But in the physical market in the East, what matters is, can a solar panel manufacturer secure the 50 tons of silver they need to keep their production line running? What matters is, can an electronics company get delivery in the next 30 days? What matters is, can an EV producer source enough silver for the battery systems they have already committed to delivering? These industrial users do not care about chart patterns or moving averages. They care about one thing. Can they get the physical metal they need, when they need it, in the quantities they need? And right now, the answer is that it is difficult. Supply is constrained. Lead times are extending. Premiums are rising. That is why Shanghai is paying $88 while COMEX is trading at $75. What you are watching in real time is not a single unified market correcting. You are watching the strain on a derivative system that expanded far beyond the physical supply it claims to represent. For decades, futures markets and commodities operated on the assumption that physical supply was effectively unlimited. That assumption is breaking. It is being tested by industrial demand growth outpacing the ability of mine supply to respond. Silver production is largely a byproduct of other mining operations. When silver prices rise by themselves, it does not instantly translate into more production, because there is no silver-only mine that can just flip a switch and double output. Look at the bank participation data. 5 U.S. banks are holding net long positions in silver derivatives, but 17 foreign banks are holding net short positions. Those foreign banks, likely European and Asian institutions, are short on COMEX and simultaneously facing squeeze conditions in London, where physical supply is tight and lease rates are elevated. When industrial demand overwhelms the paper structure, when delivery requests drain warehouse inventory faster than it can be replenished, when export restrictions limit the ability to move metal between regions, the short side faces an increasingly difficult problem. They cannot easily cover their positions. They cannot source physical metal at reasonable cost. Margin hikes relieve that pressure temporarily. When the exchange raises margin requirements, it forces leveraged long positions to liquidate. That creates selling pressure. That creates an opportunity for shorts to reduce exposure without having to chase price higher. It buys time. It provides relief exactly when the short side needs it most. This is not conspiracy theory. This is basic incentive structure. When you are under stress, when your positions are moving against you, you seek relief. Margin increases create that relief by forcing the other side to sell. This is not the first time silver has experienced this precise sequence. Rally into supply tightness. Momentum builds. Rules get tightened. Margin requirements increase. Forced liquidation creates violent pullbacks. The pattern has repeated across multiple decades with remarkable consistency. In 1980, silver price did not simply reverse because fundamentals deteriorated. The market's rules were changed. Position limits were implemented. Margin requirements were raised dramatically. The Hunt brothers and other large longs got forced out. The selling cascade that followed was mechanical, driven by rule changes and forced liquidation. In 2011, you saw a similar sequence. Silver rallied from around $18 to nearly $50 in months. The CME responded by raising margin requirements 5 times in 8 days. Each increase forced some traders out. Each forced exit added fuel to the next wave of selling. Now in 2025, the same pattern is emerging. Silver rallies from $22 to over $80. Margins get raised multiple times in a short span. The latest increase gets timed to the holiday period, when liquidity is at its annual minimum. The resulting sell-off looks terrifying on charts, but the mechanism is identical to what happened in 1980 and 2011. The outcome of these liquidation events is always the same. Ownership transfers from weak hands to strong hands. Weak hands are over-leveraged traders who get forced out by margin calls they cannot meet. Strong hands are cash buyers, long-term holders, and industrial users who can absorb metal at discounted prices without facing leverage constraints. Here is what makes commodity volatility fundamentally different from financial market volatility. In stocks, when price falls sharply, sellers appear. Supply of shares available for sale increases as price falls. But in physical commodities, supply is inflexible in the short term. Mine production does not respond to overnight price changes. A 10% drop in silver price does not cause mines to suddenly produce more metal. Permitting for new mines takes years. Development takes billions in capital expenditure. Output cannot scale rapidly in response to price signals. So when silver drops 11% in the single session, it does not create new supply. The metal that industrial buyers need for solar panels and EVs and electronics is still exactly as constrained as it was before the margin hike. The delivery demands that drained 15,000 tons from COMEX warehouses this year do not stop because futures price fell during thin holiday trading. The fundamental supply and demand picture is unchanged. The volatility you see on your screen is happening in the claims market, in the paper layer of futures and derivatives. The physical market beneath operates on longer time frames and responds to different incentives. Industrial buyers do not panic sell because of a red candle. They do not have metal to sell. They are trying to acquire it. Silver is not moving in isolation. The entire commodity complex is showing stress signals. Copper has been rallying strongly, posting one of its best December performances in decades. Platinum and palladium are both showing delivery stress and premium expansion. Base metals and precious metals are all moving together, all showing signs that the derivative structure that managed prices for years is reaching its limits. When you measure these metals in gold instead of dollars, the distortions become even more visible. Copper, measured in gold, is currently trading at roughly 18% of its long-term historical average. That means copper has been suppressed, held down far below its historical value relative to gold. The same pattern shows across industrial metals. They have been cheap in real terms for years, held down by derivative expansion that created the illusion of plentiful supply even as physical inventories declined. That gap between paper pricing and physical reality is now closing. Why is this happening now? China looks at U.S. fiscal policy, at deficits running over $2 trillion annually, at debt that cannot be repaid, at a dollar losing purchasing power, and they make strategic decisions. Restrict exports of rare earths. Restrict exports of antimony. Restrict exports of silver. Secure strategic resources. Build domestic stockpiles. Reduce dependence on Western financial markets. Trade tensions accelerate this dynamic. Tariff threats create uncertainty. Supply chains fragment. Countries prioritize domestic industry over exports. The integrated global commodity markets that existed for decades are being replaced by regional blocks with different pricing and availability. The derivative system was built for a different world. It assumed free flow of goods, assuming arbitrage could keep prices aligned, assuming supply would materialize to meet demand. Those assumptions are breaking, and margin hikes and delivery squeezes and widening premiums are the symptoms. So what signals actually matter more than one day's price action? What should you watch to understand whether the fundamental thesis is intact or broken? Physical premiums are signal number one. If paper price falls, but physical premiums hold steady or widen, that tells you the disconnect is real. Watch the Shanghai premium over COMEX. Watch retail coin premiums at major dealers. Watch wholesale bar premiums that industrial users pay. Inventory levels are signal number two. Is COMEX registered silver, the metal available for delivery, draining or rebuilding? Are London vaults outside of ETF holdings being depleted or replenished? The actual ounce counts tell you whether physical demand is continuing to pull metal out of the system. Delivery behavior is signal number three. How many futures contracts stand for delivery in the January contract? How about February? If industrial users keep demanding physical settlement, if they keep pulling metal directly from exchange warehouses rather than buying in the wholesale market, that tells you normal supply channels are insufficient. Lease rates are signal number four. Are they normalizing back toward 1% or 2%, or staying elevated at 6 to 8%? Lease rates reflect real borrowing costs in the physical market. They are set by entities that hold actual metal, making real economic decisions. They cannot be manipulated the way futures prices can. And watch for continued widening of the Shanghai to COMEX spread. If that spread keeps growing, if it goes from 13 to 15 to 18, that tells you the break between paper and physical markets is not healing. It is getting worse. If you were trading with leverage, if you got caught in this margin squeeze, you learned the most expensive lesson commodity markets teach. You can be completely right about fundamentals and still get destroyed by mechanics. You can correctly identify a supply shortage, Correctly understand that industrial demand is overwhelming mine supply. Correctly predict that prices will go higher over time and still lose everything because margin rules changed and forced you out before your thesis could play out. Being right is not enough when you are leveraged. Timing matters. Rules matter. Liquidity matters. The market can be pushed around by technical factors for longer than you can remain solvent when using borrowed money. If you held physical metal, if you own coins or bars without leverage, you learned a different lesson. You learned that paper market volatility is noise unless it fundamentally changes the underlying supply and demand picture. And nothing changed. China's export licensing takes effect next week. The 15,000 tons that stood for delivery this year already drained warehouse inventory. Lease rates remain elevated, signaling physical tightness. Industrial demand for solar and EVs and electronics continues growing. The setup that drove silver from $22 to $80 this year is intact. What changed is the price at which claims are trading on COMEX during the lowest liquidity period of the year, after a margin increase forced over-leveraged traders to liquidate. This is where discipline and emotional control separate outcomes. The majority of market participants are emotional. They are over-leveraged. They are reactive. They see red candles and panic. They lock in losses at exactly the worst time, at the bottom of a liquidation cascade, selling to buyers who have been waiting for exactly this opportunity. Disciplined buyers operate differently. They do not watch candles. They watch constraints. They do not react to volatility. They prepare for it. They keep cash available specifically for moments when forced selling creates disconnects between price and value. They wait for the liquidation to exhaust itself. They wait for signs of stabilization. Then they act methodically while others are still paralyzed by fear. After margin-driven liquidations, markets typically whipsaw. They bounce hard as short covering kicks in and opportunistic buyers step in. Then they dip again as some early buyers take quick profits. They test the lows. This volatility continues until the market finds a range where buying and selling pressure balance. Expect attempts to shake confidence. The narrative will flip aggressively. Headlines that were bullish last week will turn bearish this week. Analysts who were projecting triple-digit silver will suddenly explain why $60 is the top. But certainty is usually fake. The people speaking most confidently about what happens next are usually the people who understand the market least. The honest answer is that nobody knows whether silver bottoms here at $75 or tests 70 or bounces back to $80 next week. Short-term price action after liquidation events is unpredictable. What is not uncertain is whether the fundamental setup changed. Did the margin hike create more silver in the ground? No. Did it reduce solar panel production? No. Did it eliminate demand for electric vehicles? No. Did it cancel China's export licensing that starts in days? No. Did it reduce the 15,000 tons that already stood for delivery? No. Did it cause lease rates to normalize? No, they are still elevated. The margin hike changed collateral requirements for futures traders. That is all. It made leverage more expensive. It forced over-leveraged positions to close. It created temporary selling pressure during a low liquidity period. None of that changes the underlying story. If the fundamental setup is unchanged, if industrial demand is still growing, if supply is still constrained, if China is still restricting exports, if lease rates are still elevated, then the real question is timing, not direction. The question is not whether silver goes higher. The question is when and from what level. Silver fell because the exchange raised margin requirements, forcing leveraged long positions to liquidate. The move looked dramatic because thin holiday liquidity amplified the cascade. The speed shocked people because most market participants do not understand how forced liquidation works in low volume conditions. But the move did not change the fundamental supply shortage. It did not change industrial demand for silver in solar, EVs, electronics, and grid infrastructure growing faster than mine supply can respond. It did not change China's strategic decision to restrict exports. It did not change the 15,000 tons that exited COMEX warehouses this year. It did not change elevated lease rates in London, signaling physical tightness. What the move exposed is the fragility of leverage in commodity markets. It demonstrated that paper claims can be pushed far from physical reality when liquidity vanishes and forced selling cascades through a thin market. It showed that timing matters as much as being right about fundamentals when using borrowed money. The next chapter will be written by physical market signals, not by paper market volatility. Premiums, inventories, delivery behavior. lease rates, and global price alignment. These are the metrics that reveal whether the underlying thesis is intact or broken. These are the indicators that separate noise from signal. After understanding the mechanics behind today's move, after seeing the industrial demand data showing 15,000 tons of delivery requests, after learning about elevated lease rates and China's export restrictions, after recognizing that open interest is falling while price has been rising, does today's drop look different than when you first saw that red candle? Does it look like a trend change or a technical shakeout?